The Canadian real estate stagnation has just begun, at least according to a big bank. We're going to get into what all this means and what could potentially happen by using a big G7 economy that has actually had this happen already with their real estate bust, and it's not what you think. So the great Canadian real estate stagnation has just begun, according to BMO. So they say the hype around falling interest rates have so far failed to materialize into real estate movement. Headlines have been focused on the annual uptick in sales, but they remain historically weak. At the same time, prices have barely budged despite interest rates making a sharp drop. In fact, home prices moved slightly lower over the past year. So let's get into this and take a look at what they're talking about there. So mainly talking about interest rates here. And this brings up a really key point here, is that the Bank of Canada doesn't control interest rates. And that's the thing. A lot of people believe that the central planners, specifically the Bank of Canada, control interest rates. But when you actually look into it, not so much. And I'll give you evidence of that in a second. So the policy rate was at 5% and it's now all the way down to 3%. Obviously, we had the interest rate cut that came out last week, and the Bank of Canada is saying more cuts could potentially be on the table. The Canadian dollar is weak, but they're not worried about that causing any inflation, and the bond market isn't worried about inflation either, as we're going to get into right now. So what's on the screen right now is the bond yield for the 5-year government bond in Canada. And the reason why I'm showing you this is because this is what the 5-year fixed mortgage rate is in part comprised of, this and a risk premium. So basically that can mean rates can go up if the risk goes up, or it can mean that banks become more constrained and they don't want to lend. And that's what typically happens in a deleveraging cycle, which is what we're likely going into with the fear stage that we're heading into in 2025. So if you look at what's happened here, where I've got my mouse right now, this is around August of 2024. Each one of these bars represents a week here. And you know, where we are right now, we're at similar levels to where we were in May 2023. And it's actually been trading at these levels now since July. And obviously the Bank of Canada, I believe their first rate cut was around June or May of last year. So it's pretty much been sideways, meaning that the Bank of Canada has been cutting interest rates, as we can see here. So yeah, the first cut was May. So the Bank of Canada has been cutting interest rates, but the yields have just been trading flat since. So what does that mean? That means your 5-year fixed rate mortgage is essentially not moving, even though the Bank of Canada is bringing down rates. Now that entices more people into variable rate mortgages, but a lot of people have been burnt with those and they're not going to be looking to jump into those so quickly. So I think it's an interesting point to really think about. So Canadian interest rates are falling, mortgage rates not so much. Why haven't rate cuts driven a large boost to home sales and prices? It's natural to assume it would have, especially when combined with policymakers spending hundreds of billions on stimulus to boost housing activity. So this is things like the CMB program that they announced. The CMB program, of course, is these government bonds that are comprised of mortgages that they then buy off the banksters themselves using your taxpayer money, and then they sell off these bonds that are backed by the Canadian government. So they're pretty much deemed risk-free by the market, yet the yield on them is slightly higher than like a government bond, like buying the 5-year government bond. So ultimately, it comes down to affordability, and at current price levels, mortgage rates haven't sunk quite far enough. With 5-year fixed rates now in the low 4% range, even 3 more Bank of Canada rate cuts this year would only bring variable rates down to similar levels. And that's important to acknowledge. And the 5-year could not move at all. I mean, rates could come down and the 5-year just trades flat, as we were talking about. And in that scenario, mortgage rates just stay exactly the same. And it's going to be interesting to see what happens. You would only see those variable rate drop. And the thing is, obviously, as well, that you have to acknowledge is investors aren't pouring into the market anymore. So now you're completely dependent on affordability actually being a thing, whereas in the past it wasn't. And as more and more banks get burnt on bad loans, which we're already seeing loan write-offs skyrocket, then it's going to be really interesting to see what banks do and if they start to restrict and constrain lending. And if you want to know what that scenario actually looks like, you can go to the UK, which had a housing bust as well. And basically this chart that we're looking at here goes all the way back to 2008. So where I've got my mouse right now, and this is linked so you can go and look at this chart for yourself. It's based off the nationwide UK house price inflation adjusted index. And obviously this is adjusted to the phony CPI. So we know that it's actually way worse than this. And prices right now are down 20% in real terms since 2008. So think about that. Prices have really stagnated in real terms. They haven't gone anywhere. And I think this is the likely end scenario in Canada, is you're going to eventually see prices that start to rise again, but actually trying to use real estate as a way of growing your wealth and actually investing in real estate for returns is just going to be a complete failed exercise in Canada, because it's not going to work if obviously the money is just sat there depreciating because of inflation and other things that are happening. And I think the likely scenario is that you're just going to see real estate stagnate. So in the UK, after the 2008, you had a sharp decline in real inflation adjusted prices, and then some up and down, and then way down again. And this down part here isn't because nominal prices actually went down. It's because the inflation was so high, and obviously that compounds over time as well. So, I think it's far more likely that you see this type of scenario that happens in Canada. And now you're also looking at debt that is at $3 trillion. And you've got to ask yourself the question, well, can debt actually continue to grow at the rate it's growing? I mean, it's now at $3 trillion and people's incomes aren't growing at this rapid rate. If you look at the expansion of debt since 2004, it's really obvious that around 2003, 2004 was really when this bubble started, because the debt was just growing at a way quicker rate than people's wages. And then that just began to accelerate even more. And what people forget is this bubble was driven by easier lending policies that were government subsidized. But just because they are government subsidized doesn't mean that those lending policies can't go bad. And easy lending leads to the same thing. It leads to bad loans eventually in the end, and getting to a point where debt can't grow anymore, unless obviously inflation and devaluation of the dollar is happening at a way quicker rate than even that, and wages are actually rising in that environment. But another thing that you have to take into account as well, with the interest rates coming down and the argument that you keep seeing being peddled in the mainstream media, is unemployment is going up, which totally offsets and invalidates interest rates coming down anyway. Now, there's around a 6-month to 18-month to 2-year lag with interest rate hikes and cuts anyway. But when you look at unemployment rising, layoffs just getting worse, more and more companies are shrinking hours for workers as well. You've got all this uncertainty right now in the Canadian economy. You've had a GDP per capita recession since 2022, and the recession's been obvious to us on this channel. So the economy isn't doing so great. So are people going to be enthused and enticed to go out there and sign up for a massive mortgage right now? No, they're not. And it doesn't look like that sentiment is suddenly going to flip anytime soon, just because the Bank of Canada is lowering rates, because as we said, they don't control the rates, and that's what's most important. They just control the rates at the front end, that variable rate, which is inherently risky. And like I said, a lot of people have been burnt with that. So I doubt that that is going to be a really hot thing that lots of people are rushing into again, considering what just happened with variable rate mortgages and all the uncertainty about what's going to happen with with inflation. I mean, prices are still rising. They're just not rising at the rate they were before. And because of the compounding effect of inflation, prices are way, way higher. So what people can afford is actually way less. And the CPI, it doesn't illustrate that at all. So anyway, guys, I hope this was kind of helpful for you. If you enjoyed this video, I'd highly recommend that you check out this video here about people escaping Canada. And if you're looking for a VPN and want the fastest VPN, go to expressvpn.com/marketmania. Also helps out the channel. And I will see you in the next one. Take care, guys. Bye-bye.